A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Cochran, a Chief Currency Analyst. Looking forward to getting us through today's event, explaining the dynamics of the markets. Remember, these workshops are designed to find out a high probability currency pair to trade in current market conditions. So I'm going to be running through a couple of high probability currency pairs for trading, and I'm going to be framing that around trading today's CPI decision. So really looking forward to running this event, really looking forward to running this workshop. So if you can just let me know you can see my screen and hear my voice okay, that would be great. Just pop in the question or the chat box so just so I know you can see my screen and hear my voice. Otherwise, I will assume that that's all okay unless I hear otherwise. I will now go over to the other screen and just explain what the market dynamics are before diving into the Canadian CPI data. And I will be using some of the charts that I use as part of my role as the financial source analyst. It is a service and a product that all HYCM clients can have access to. So without further ado, I will take us through the session. Now, what's going on at the moment? Well, once again, we're seeing a sharp move higher in bond yields. Now, if I just take us to the bond yield chart, you'll see that bond yields are moving higher across the board, okay? 10-year yields pushing up higher, German bonds in positive territory for the first time in a long time, going back, you've got to go back all the way to, let's have a look. The last time they were in positive territory was around April 2019. Just see that yields have been moving lower and lower and lower. Now, bonds have traditionally been bid recently due to the yield they've been offering, and with inflation being so low, the bond market was offering some good incentives for investors looking for somewhere to park their cash. And often many asset managers have a split, an equity bond split of between 60 and 40%. So in certain conditions, you have 60% of your portfolio in equities, 40% in bonds, and then that flips depending on what's going on where we are in terms of the economic cycle. So with yields now starting to push higher, that's bond markets being sold off, because the bond market is very sensitive to rising interest rates. That's why currency traders keep an eye on the bond markets. And the reason yields are moving higher is because interest rates are expected to move. Now, 10-year yields are moving higher above that 1.8% region now. Now, the surge higher since the start of the year is on expectations that the Fed is going to have to be way more aggressive in terms of their rate hike moves. Now, if you just take a look at the Fed fund futures, you can see that the Fed fund futures are now pricing in a total of 4 interest rate hikes for the US for December 2022. So 106 basis points. So that's over 4 interest rate hikes are now priced in. There was, expectations were growing yesterday that, oh, the Fed would maybe have to hike twice in March, do a double hike. And I was reading some investment report from I can't remember the name of the firm, but they had quantitative tightening happening in 2025. So the balance sheet reduction was due to take place in 2025, according to their calculations. Now, their calculations was bang on the money. That's what I think 99% of people would have said. And that was in November last year. Now, we're at the stage where quantitative easing is due to happen finish in March. The first interest rate hike is due to happen in March, and quantitative tightening is due to happen in the summer of this year. So, that's like a 3 or 4 year acceleration in terms of Fed policy. And it was only last year that the Fed itself didn't see any interest rate hikes till 2024. Right, now you see what that move higher in 10-year yields is all about. Now, can that be maintained? That's the question. Now, typically speaking, when you've got the yield curve, you've got the front end, your 2s, your longer end, your 10s, your 20s, your 30s. Now, your shorter end of the yield curve tends to move higher in interest rate expectations. So it's not a surprise to see the 2s moving up, but it is a bit of a surprise to see the 10s still moving up. Because medium term growth is expected to slow, inflation is expected to slow. So you'd expect the 10-year yields to move lower. They keep moving higher at the moment. That is just helping lift yields across the world because the Fed's expected to be on this very aggressive rate hike path. Now, look how that's impacted central banks around the world. Fed expected 4 interest rate hikes, December 22. The Bank of Canada expecting 6. We'll get onto that, why that's important for the Canadian CPI later. The Bank of England expecting, 4 interest rate hikes this year as well. RBNZ expecting 5 interest rate hikes. Do you see? So the expectations have been rising that interest rate levels are going to rise. That's why the bond yield market keeps moving high. Now, the concern for equities is as follows. If interest rates rise, that means loans cost more, people have to pay more on their mortgages, people have less disposable income. So higher interest rates can mean harder financial conditions for companies. That's why we've been seeing the NASDAQ moving lower alongside other global stocks in anticipation of harder financial conditions ahead. So stocks can't keep their recent moves high. Now, look how high stocks have been rising since this COVID-19. Do you see that path? Now, the reason stocks have been moving so high is because interest rates are low. Not only were interest rates low, I mean, virtually everyone was down to zero. That's the best financial conditions for people. People could take hundreds of thousands of pounds of loans out and pay like 1% interest. Incredible conditions. It's designed to stimulate the economy, right? So people take those loans out. Of course they do. They can afford them. But if interest rates start rising, then those loans are less attractive. If it's up to 4%, 5%, you'll think more closely, won't you? Whereas if you're thinking I could take an interest-free loan at 1% and I can see a clear path for growth, then you're much more likely to take it, you see? So companies have been taking advantage of those business conditions. And not only that, but governments have been giving fiscal stimulus to countries. Governments have been providing lost wages. They've been supporting individuals. They've been supporting companies. So all this has meant that stocks have been able to surge. But eventually, the party has to end, right? Now, look, stocks keep moving higher. So I'm not like, this is not I'm not a doomsayer. But you can see we have moved through this key support level. Now, if price closes below that support level, that is significant. We are testing that in the NASDAQ. If it can close back above, then we may make another move higher. But what investors are concerned about is that the Fed's making a policy mistake, that they're hiking interest rates just as financial conditions are worsening, growth and inflation. Right, now you have enough of the big picture to understand what's important. So this is why earnings season is now very important for financial markets, right? So if you take a look, we've got some big earnings coming up. We've got Netflix. They tend to have a very strong seasonal pattern around this time of the year. In fact, let me just show you this pattern for Netflix. It's incredibly strong and worth looking at. Let me just show you that. Right, if you just take a look at, I'll just look at Netflix. Right. You look at so let's go 19th of Jan to the end of January, right? Do you see that annualized return is 16,000%? the maximum profit was 71.45% in 2013. You know what I mean? Absolutely incredible. And in the last 10 years, 9 times out of 10, Netflix has gained strongly at that time of the year. Right? So an incredibly strong seasonal pattern. And, you know, over 15 years, it's only lost value once, right? At 71.45% profit. So going into earnings for Netflix is really, you know, quite striking. Comes after the close, so that would be a potential for a Friday open. So what we're looking for here is if companies come up with their earnings and they start revising. Now, there's a bias in financial markets when it comes to, like, you know, projecting what earnings companies make. They tend to underpromise so they can over-deliver. You know the psychology. It's always better, you know, if you said to someone, you know, the financial result is 2 million and then it's 2.2 million, everyone's like, oh, that's fantastic. But if you said to people the financial result is supposed to be 2.4 million and it was 2.2 million, they'll be disappointed, right? So Wall Street do that psychological impact. They tend to underestimate the earnings, revenues, and EPS so that you get that, like, nice feeling. So that means that if earnings are amiss, or even as expected can be seen slightly negatively. But the key thing here is, what do companies project for the future? What are they projecting for the future? If we start seeing companies projecting negatively rather for the future, that's when we could see this correction stocks accelerate, right? So that is a very key thing to be looking at. So we're looking at yields and we're looking at stocks earnings season. Now, coming into the Canadian CPI data, and then we'll get on to potential currency pair to trade. Now, if you look here, don't forget, if you're new, do check out my blog here. And I've got a very good central bank watch. And here you can see the last Bank of Canada interest rate decision in December, right? And what they did is they revised growth lower, and they mentioned uncertainty surrounding oil prices, and they also mentioned that growth was going to be slowing. Now, at the time, oil prices were sort of in question about how they were going to go. Now, oil's really been supportive for CAD, and if you just take a look at oil prices, look. Let me show you here now. You see oil's pushed above that 85, 86 handle. That is a bullish development for oil. Now, the reason oil's been moving higher, there's been low inventory levels, there's been high demand. EIA have revised higher their growth demand forecast for oil. We also had confidence over OPEC Plus's last policy meeting, where they were happy to increase production by 400,000 barrels per day. We also had Iraq-Turkey pipeline halted overnight, and that has subsequently restarted. But medium term, if inflation is expected to move lower and growth, then normally that's a negative on oil. So oil is approaching some key technicals levels, particularly that 90 handle, that test of that 1, 2, 3, and that big psychological number around 90, as well as that sort of key overhead resistance level. So 90 is a key level for oil, 90, 91, that kind of region. And if you notice the US dollar CAD pair, I'll show you that the US dollar CAD pair is highly negatively correlated to oil. So if you look at US oil here, now this is US oil inverted, right? I'll just put it here. So this is when, you know, if the green line's going up, that's US oil, right? You see rising oil, falling US dollar CAD. Rising oil, falling US dollar CAD. Rising oil, falling US dollar CAD. Okay, rising oil, that's when it bucked the trend. Okay, it doesn't always work, but the correlation is very, very strong. You can see here falling oil, rising US dollar CAD, right? So one of the very, very crucial understandings to have is that oil is very negatively correlated to US dollar CAD, right? So that's when you put the inversion of the scale. So in other words, what that means is if we see oil push lower, and this is the oil chart inverted, then you'd expect US dollar CAD around this key support level. So if we see oil lower, and then crucially, we see a Canadian CPI miss, that would be very good for upside in dollar CAD from market. Stops below the low, looking for a first stop up to 1.2550, then to 1.2600. A nice potential scalp trade. Now, this is what we need to look for. The expectations are that year on year, the core reading is going to come in at 3.5%. Now, Canada is not struggling with inflation like some of the other world's major central banks are. The Fed, they're struggling with inflation at 7% headline. Incredible. Become very politicized in the US. I was speaking to a US media house for around 40 minutes just on inflation. I was brought on to talk about currencies. I ended up talking about inflation for 40 minutes US. That's how politicized it was. Now, it's not so politicized in Canada, but expectations are that next week, 2 weeks' time rather, the Bank of Canada will meet, and in their January meeting, the expectations that they're going to hike interest rates. Now, this is updated since, but the expectations are that they're going to hike by 25 basis points in January. So in just like 8 days' time, that is next week. Now, by March, expect it to be nearly 2 times. Now, the thing that will pressurize the Bank of Canada will be inflation. Oil has been supportive. Now, remember, the outlook for oil is complicated. Near term, there's drivers. Medium term, if growth and inflation slows, that's normally a headwind for oil. So the Bank of Canada will know that. So they'll be nervous potentially about the recent gains in oil. Now, the other side, the flip side for oil, is that with the world pivoting towards green energy, renewable energies, there's this huge enthusiasm for renewable energies, and there's not the same enthusiasm for investing in oil infrastructure, new wells, new equipment. All the focus is on renewable energies. So that means that the oil industry is at risk of underinvestment, which could mean that they have lower levels of supply, which could inadvertently support oil prices, particularly if demand gets back. Now, you know, for all the talk about green energy demand, yes, we are expecting that to increase steadily year on year. I'm not denying that. But what I'm saying is that the majority of our vehicles still use oil. Planes, the largest users of oil, still fly on fossil fuels. Cars, the majority are still fossil fuel based. So the point is, it's not a political statement, it's just a logical statement that if we pivot towards green energies too soon without actually providing the infrastructure, it's all very well everyone talking about electric vehicles, but they are not affordable, there's not enough to go around, and we'll have to use petrol vehicles. So as a consequence, oil prices could end up having some longer term drivers to the upside as well, despite inflation expectations expected to fall, which typically weighs on oil. Okay, you get the point. There are some issues about oil. But if the Bank of Canada have a very, very low inflation print, and if it comes in below minimum expectations, so the minimum expectations is 3.2%. So what we're looking for with the core, we're looking below 3.2%. With the common, it's 2%. Now, if that's below, 2%, 1.8, 1.9%, then you could expect some of that CAD strength to dissipate. Now, let me just show you where CAD is in terms of its longer term outlook, right? And I'll also show you something else that's really interesting. Right, this is the Canadian dollar, right? And you see the Canadian dollar is ripping higher recently. Now, that rip higher is largely on oil prices. Do you see how closely the Canadian dollar tracks oil prices? So oil in the green, rising oil, rising CAD, rising oil, rising CAD, falling oil, falling CAD, rising oil, rising CAD, falling oil, falling CAD, right? Now, what we're looking for here is ideally oil to pull back lower and a miss in the Canadian CPI will give us the best opportunity. A short-term scalp trade will be possible just on the fact that the CPI is a miss, because we are seeing Canadian dollar just pushing high now. That is very high. Got 6 interest rate hikes priced in. That all seems overvalued. So anything that's negative means the Canadian dollar is very vulnerable to a correction. Okay, and that's the best opportunity that we have from the pair, and the US dollar CAD pair is technically a very nice place to potentially benefit from that. Okay, so looking potentially, if we get a miss in the CPI, that just buying at market, looking for a move higher. The dollar itself, dollar index, has been moving higher on those interest rate hike expectations from the Fed. So that's opportunity sort of number 1 that we've got. Now, opportunity number 2 is related, and it comes on the Australian dollar. Now, just take a look here at the Aussie dollar. Now, at the last interest rate meeting, and again, don't forget, check out my blog here. These are the 3 things that the RBA are looking at. Now, I'm seeing them potentially turning hawkish. At the last interest rate meeting, they said, look, these are the 3 things. What's going on with the Australian bond market? What are the central banks doing? And how much progress we're making towards full employment inflation target? So these 3 principles, what the RBA needs to sort of turn more bullish, right, to end that QE program. So number 1, Australian bond market. Well, look, boy, if you want to see a reaction in a bond market, and you can see the Australian bond market, look at that. It's just been, yields have just been surging higher, okay? Pushing above those recent highs from October 2021 on the 10s and March 2021. So bond market, tick. 2, the action of the other central banks. Federal Reserve is the world's largest central bank. They're expected to raise hikes now by 4 times this year. Okay, RBNZ, 5 times. RBA, will they follow? Well, other central banks are slightly leading. How's employment doing? Now, the last employment data was very, very good, okay? If we get a good employment data today, then that's meeting all the criteria. So that's upside in the Australian dollar. And now I was looking at Aussie Swiss franc upside potentially, from January 12th, January the 13th when I wrote this. Iron ore, coal prices are high. All of these support the Australian dollar, right? See iron ore prices continue to move higher. Coal prices continue to move higher. They're moving higher, and use that as a trade weighted index proxy for the Australian dollar. Huge, around 20% of Australia's exports are iron ore. Over than 20% are iron ore and coal. So what's good for iron ore and coal is also good for the Australian dollar. Also, China has been receiving a lot of support recently, which is an element that wasn't the case when I first mentioned that. So you can see here, China A50, medium term looks very good for longs. You can see that this pushing up into that trend line. People's Bank of China cut interest rates by 0.1%. Some analysts see further 0.20% of interest rate cuts. So China was slowing down last year, right? So you can see that we went from a peak of 26.44 down to 14.660. Now the People's Bank of China are easing. So China's in a different place to the rest of the world, right? It's kind of had its slowdown, and now it's looking at picking up again with easier financial conditions. Now, the Australian dollar is often used as a proxy, right, for the Chinese yuan. So if you just take a look here, let's have a little look here at the Aussie, all right? And if we just, let's put on to this chart right? You see? You see how closely the Australian dollar has been following the Chinese indices? Now, the reason that is, it's for a very good reason. It's because 80% of Australia's exports go to China. So when China's doing well, Australia's doing well. When China's doing badly, Australia's doing badly. That's why the Australian dollar is often traded as a proxy for the yuan. So all that means is that if China's main index, the China's 50 index rather, is pulling higher on a more accommodative monetary policy perspective from the central bank and from government, then that should also lift the Australian dollar, right? That's all I'm saying. So all of that means that this employment data for Australia is important. Now, here's the detail. The detail is employment. Expected, last one was 366,000. It was a fantastic employment report. See, another good one, above maximum expectations, and expectations will increase that the Bank of Australia will be hawkish in their next interest rate meeting. We want to see above 90,000. That's what we want to see. Participation rate higher, above 66.3. Unemployment lower, 4.4% or lower. That would be the most hawkish outlook. Remember, look at the employment data, always looking what is the full-time to part-time employment ratio. The higher it is on the full-time employment, the better, right? So if the full-time employment is high, that's what we want to see. The best opportunity would come this way. If we saw, let me just show you, if we saw a miss in the Australian CPI data, right? Hang on, let me, I'll show you the actual chart, right? Right, here we go. Right, okay, here we go. So here's the Aussie CAD chart. We'll look at that on the day. We can see we're right down that key support level. Key support. So if we see a CPI miss and an RBA or an Australian dollar employment beat, then you could expect to see the Australian dollar CAD move high medium term. Now, what we're looking for is this. Here's the bond yield spread. Now, the bond yield spread is just a way of seeing how current countries do. You see how the price tracks that bond yield spread? So as the bond yield spread moves higher, so does price. Bond yield spreads moves higher, so does price. Bond yield spreads drops lower, so does price, right? So if we see the bond yield spread surge higher, if the outlook changes, Canadian CPI is a miss, Australian employment data is a B, then Aussie CAD upside makes sense. Okay, so look out for that. So the way in would be if CPI is a miss, then you could go long Aussie CAD and see how it goes coming into the CPI data, coming into the employment data overnight. Okay, folks, I hope that's been good. I hope you're ready. I hope that gives you a good understanding of how to do macro analysis in the short term. So thank you all very much for your time again. Don't forget, do come back here on Monday and we can get ready for the coming event together. Don't forget, I am here on Monday, 12:30 p.m. GMT. You can just see the thing here and register. Say, a number of you guys I've been knowing for a long time now, so it's really, really enjoy this time. Nikita, can you please give a quick view on silver? Yeah, sure, Nikita. Absolutely, absolutely, we can. Now, right, silver and gold are very much driven by what's going on with real yields, okay? So what you can see, I've got gold pushed on here, but I'm just gonna put on silver for you because it equally stands in Nikita, right? So there, so silver is in the purple, right? So what you want to see, Nikita, do you see how when you see, this is the tips that we use as a proxy for real yields, that TIP, right? Now, the code for that is here, Amex tip, right? Now, at the moment, we've got two things that are working against each other. So you've got the dollar moving lower but real yields used by this tip proxy moving higher. Now, ideally, look, do you see when you've got real yields in the dollar moving lower, silver moves higher. Real yields in the dollar moving lower, silver moves higher. Nikita, what? Sorry. Thank you, Nikita. Sorry about this. It's really annoying sometimes. It's very easy to switch screens, but the computer not. Nikita, sorry. Right, apologies. Right, I'll start again. You see here, this is the tips. Now the code for tips on TradingView is this Amex tip. Let's take a quick screenshot if you want. Right. Now tips are used as a proxy for real yields. When real yields, tips are moving higher, and when the dollar's moving higher, you see when they're both moving high together, you get downside in silver. Right? When you get real yields and the dollar moving lower, you get upside in silver. Real yields, dollar moving lower, upside in silver. Real yields and dollar moving lower, upside in silver. Real yields and dollar moving lower, upside in silver. At the moment, they're working against each other, where you've got upsides in yields, downside in the dollar. So we've got this more range-bound action. What I want to see is I want to see tips moving lower. Now, the first indication you'll get from that, Nikita, is if you start seeing 10-year yields moving lower sharply. If you see 10-year yield moving sharply, if they move too sharply, then you'll also see dollar strength. So that's not what you want to see. You want to see these two moving together. So if you see US 10-year yields moving lower and the dollar starting to move lower, then you'd expect more upside in silver. So right now, I think the bias favors buyers because we are expecting real yields to move lower in the medium term. But it's a story you've got to keep on top of, okay? But at the moment, I would say that the bias favors upside. And if we start to see the dollar moving lower and real yields moving lower, then we'd see a sharp acceleration higher in silver and gold. Nikita, does that help? Yeah, good. Good. And it's like a very similar outlook for and one other little pair worth looking at, like New Zealand dollar Swiss franc breaking higher, that's suitable for buying from market. New Zealand dollar yen moving higher, suitable for buying from market. Just stops below that 77.36 region, or stops just below 0.6176. And remember, ANZ, they've revised up their forecast for the RBNZ to hike interest rates to 3%. Rising interest rates, rising currency. So that's positive. The risk to this trade is if we see risk off trading again, then we can see Swiss franc bids and the Japanese yen being bid. Nikita, anytime, use me, I'm here. You know what I mean? Ask me questions. This is your opportunity. Okay, folks, thank you all very much. Don't forget, be back here on Monday. Take care. Have a very good rest of trading session. Watch out for that Canadian CPI, folks. Take care now. Goodbye.